Welcome to Year 11 Accounting Unit 1, Topic 7. We're going to look at bank reconciliations. Now I've had to re-record the audio for the start of this video because I had a bit of an issue with the synchronization between the audio and the video, so it might jump around a little bit, so please bear with me. Now in this video we've got 8 different topics we're going to look at. We're first going to look at what we mean by internal control, then how businesses control their cash. We're going to look at one of the ways in which they control their cash through a bank reconciliation. We're going to look at the bank reconciliation process and provide an example of that. We're also going to look into detail at bank overdrafts. The last 2 things we're going to be looking at reconciling an account which is in overdraft, and then finally reconciling over consecutive periods, because as we're going to see, reconciliation is an ongoing process. Now, internal control. Internal control is all about the mechanisms or steps that a business has to protect its assets, so to protect its cash and its non-current assets as well. There's a number of ways in which businesses can do that. They can separate and rotate the duties that each person has within the business. So if different people, if you've got to do different things each week, it's harder for them to work out how to steal things. As the owner, you could also check your accounts randomly. So check what's going in and out of each account, and also make sure you keep accurate records. Finally, you've got to make sure that you physically protect your assets, your business as well. So put in locks and cameras and stuff like that. Money out of an account into your own account. So that'd be like the modern equivalent of the physical protection control. So cash is one of the main targets of fraud. So if you think about people stealing stuff from a business, the main thing they're going to try and steal is cash. It's because everyone can use cash and everyone likes cash. So as a business, as an owner, you need to think about ways you can stop it. So we mentioned you use your receipts. So they're the source documents. You put all the money in the bank regularly, so you don't have money sitting about in your cash register. If you use checks instead of using cash, if you've got a bank checkbook for your business, then only the person that's a business owner or has the name on the checkbook can actually use it to buy stuff. You've got to make sure you maintain your journals. They're the cash receipts and cash payments, and also clear out your registers regularly. You might see at a supermarket. If you ever go to the supermarket, you'll see a manager coming along where people are serving every now and then, and they'll check their cash drawers. And if there's a certain amount of money in their cash drawers, they'll take the money out of the cash drawer of the register. They'll put it in a bag and they'll take it and put it in a safe. So they want to stop too much money accumulating in each register. Now, the final way you can check control against cash fraud is by completing bank reconciliations. And now we're going to look at what that actually means, because these other ones, they're pretty straightforward. You know what they mean. You should know what they mean. Now, I was thinking before we get into actually talking about a bank reconciliation, I think we need to look at a little bit about what the word actually means. So, reconciliation is based on the word reconcile. Okay, the word reconcile means if 2 people have a disagreement about something, then they can reconcile their differences, and then they'll be in agreement again. Okay, so you could say if two friends are arguing, you could say you want them to reconcile their differences. So reconciling brings it back into a state of harmony, and in accounting, it also means to bring it back into a state of balance, so things are equal again. So what we're trying to do here is trying to reconcile the bank. So when we talk about reconciling in accounting, we're reconciling between 2 things. We're reconciling between the records of the business and what the business has stored in its accounting system, and we're reconciling it between what the bank has in their records. The reconciliation takes the form of a bank reconciliation statement. So we've done like statement of receipts and payments and things like that. A bank reconciliation statement is another of those type of documents. It's checking off what's in your business compared to what's in the bank. Now the question is, I should say in your business, we're talking about the cash receipts and the cash payments journal. They're the main 2 reports we're talking about. Now we need to quickly look at why would these 2 things be different. So in your business, you've got cash coming in and cash going out, and into your bank account, you've got cash going in and cash coming out as well. So in theory, they should be exactly the same, but they're not, and there's a few reasons why they're not. So into your bank, if you have direct debits and credits being made, so say you've got a phone bill that you know is exactly the same every month because you've got an agreement with the phone company, you might organise that you just directly pay that phone bill every month. So what might happen is that won't appear, that'll go out of your bank, but it won't appear on your cash payments journal until you actually write it on there. Okay. The other thing is dishonoured checks. So a dishonoured check is where somebody gives you a check for payment for a service. So we'll think about the example of a painter. She does a painting job for a house. She gets paid by a check. So on her cash receipts journal, she'll put in receive fees. She'll put in the amount, and that'll be in her business's records. She'll then send the check to the bank to get the money put into her account. But if the person that paid her doesn't have enough money in their check account, the check will be dishonoured. Another way people talk about this is saying the check bounces, because it means the money hasn't gone in because there's not enough money there. So if that happened, you'd have in your business records, you'd have a cash receipts journal entry saying cash received for fees, but in the bank, that money wouldn't be there because the check's been dishonoured. The other thing that happens is each month you may be charged bank fees. So I don't know if you guys have ever been to an ATM and you tried to take money out of your ATM from an ATM that's not your bank. It'll say you will be charged a fee of $2 to use this ATM. Ever seen that happen? So that's a bank charge of $2. Now, if maybe you're taking out $100 to pay somebody for something in your business, and the bank's charging you $2, on your record, you're only going to write down, say it was $100 that you need, you're just going to write down cash payments $100. But there's a $2 charge that's come out of your bank as well. The other thing is your bank often will charge you just for having a business account. So they might have a fee of like $5 a month to pay to keep your account with them. The other thing they might do is say, okay, you've got to check it, you've got an electronic account, and you get 10 free withdrawals every month, but every withdrawal you do over 10, you need to pay pay us 50 cents in bank charges. So that might not come in yet. The other thing you might have is where there's a deposit that hasn't been credited yet. So let's imagine you finish up work on a Friday for your business, and on Friday afternoon, you take all the money from your business out of the cash registers and you take it to the bank and you give it to the bank to put into your account. That money won't go into your bank account probably until next Monday or Tuesday when it's actually processed. So your transactions, your records will show that it's in the bank, but on your bank statement, it won't actually be there yet. Now, this is a really common one, and this is unpresented checks. So dishonoured checks are where you've been paid for something, but there's not enough money in the person's account to actually pay you for it. An unpresented check is where you've paid somebody with a check, but they haven't put it into their bank account yet. So let's imagine that again, I'm a painter, and Naomi sells me painting supplies. So I go and buy 5 tins of paint off her that I'm going to use to paint a house. I might pay her, let's say, $150 for those 5 tins of paint, and I would pay her with a check for $150. So on my cash payments journal, I'd put in $150 paid for painting goods to use, right? So that's going to be my cash payments. But on my bank statement, that money will not be taken out of my account until Naomi takes the check to the bank and says, I'd like to take this check and I'd like $150 from Mr. Williams' account to be put into my account with this check. So she might do that 3 weeks later. It's up to her when she takes the check to the bank. So for those 3 weeks, I'm going to have $150 in my cash payments journal, but the bank statement won't have that $150 there. So at the end of the day, you've got to remember the bank statement's going to have the actual cash in your account, the actual cash there, but it could be missing quite a few things. So to work at what we need to do in accounting, in our accounting system, is we need to reconcile those two things. We need to make them equal each other. We need to show that the bank statement and our internal control is the same. Okay. What that's going to do is allow us to see whether there's any money actually missing, or if there's too much or too little there. So we've got a 5-step process that we follow to work out what's missing from our bank statement and what's missing from our cash receipts and cash payments journal. So each month, what will happen is you'll get a bank statement. So if you look over on the right here, this is like what a really, really simple bank statement might look like. It will be sent to your business, and it's got down the left-hand side, it's got the dates the transactions occurred, it's got the details of each transaction, and whether it's a debit or a credit to your account. So debit's money going out, the credit is where money's come into your account, whatever reason. So you might realise it's kind of a lot like a cash payments and receipts journal together. Okay, it's just money that's gone in and out of your account. So the first thing you do is you look through your cash receipts journal. Your first step is to match through your cash receipts journal, and you go through your bank statement and you tick off the ones in your bank statement which match up with your cash receipts journal. So see this on the bank statement on the right, so there's that credit for $3 over here. If you would then look through your cash receipts journal for the 6th of the 5th and find the one that hopefully you've got a transaction for $3. If you do, you tick it off. Okay, so you've got them both sitting in front of you, and you tick it to say, yep, that's on both documents. You then go through and do the same thing with the debits for your cash payments journal. So if this was the really simple one, we'd go through and find those 2 transactions, and we'd tick them off. Now, let's imagine on your bank statement, though, there is a deposit which is not listed on your cash receipts journal. So let's say you've got a credit on the 10th of the 5th. So this could be from one of a direct credit. Let's say you've got a credit of $5 that's come in. So that one you found has not appeared on your cash receipts journal. So what you need to do is you need to take that one for $5 and you need to add it to the bottom of your cash receipts journal. So for this transaction here, you then go and add that onto the bottom of your journal. Now also, you might have some credits. Oh, sorry, any credits that have been made that haven't appeared on your cash payments journal. So let's say you've got a bank charge, so the bank charged you a fee at the end of the month. So maybe on the 29th of the 5th, they charge you a bank fee, and let's say it was for $6. You then need to go and add that to your cash payments journal. So that's going to show that you've actually your business had to pay $6 extra. Now remember, the cash receipts and cash payments journal, they just show all the money, all the cash that goes in and out of your business, right? So if your bank statement is showing that you've had to pay $6 in bank fees, then you need to put that on your cash payments journal. Yeah. Now, on your journal, let's imagine that you've got items that are listed on the last step is you might have items on your cash receipts and cash payments journal that you haven't ticked, so they're not on your bank statement. So what you need to do is you need to go and add them to your bank reconciliation statement. So that would be things like the dishonoured checks, okay, or the unpresented checks as well. Okay, so this is going through an example. So I'd leave the notes for this one and just think about just have a look at the 5 steps that you took down, and we're going to go through those 5 steps with these 2 journals. So the first thing we do is we need to look at our cash receipts and cash payments journal. Oops, sorry, I'm just going to go back. And on our cash receipts and cash payments journal, we need to tick off the items that match. So can anyone, what was that? What was the first step?
Match credit. Cash receipts.
Cool. Okay. So let's look at it. Over on the left-hand side here, we've got our cash receipts journal, and we've got 3 entries: fees for $300, fees for $500, and fees for $400. So we need to find those over on our bank statement, which we've received at the end of the month. So $300, you can see that one listed there. So yep, we've got this one for $300. That's appeared. We've got one for $500. Yep, that's listed as well. We've gone for $400. Oh, hold up. And we see this one for $400 is not listed on our bank statement. So the money hasn't gone through into our bank account. Maybe somebody's paid us with a check and we haven't cashed it yet. but we're not too sure at the moment why it's not there, but we just know it's not listed. So next one we're going to look at our cash payments journal. So we paid wages of $200. Yep, there's a debit of $200 that was made. We did pay for some cleaning to be done for $100. Yep, there. And we bought a computer, which we paid $300 for. And we look over our bank statement, and there's nothing there. The computer hasn't appeared either. So there's something going on, right? Now, the other thing is, if you look down at we've calculated our bank balance, which we do through our accounting process. We had $1,000. We received $1,200, which we can see here. So we received $1,200. We paid $600 for the month. So if we look down at our bank balance, we had $1,000 at the start. We received $1,200. We paid $600. We should have $1,600 in our account. But if we look over at our bank balance, we've only got $1,585. Okay, so there's a disagreement between the two documents, so we need to reconcile these two documents. So our next step is we're going to take, it's taking a bit to load up to go back. We're going to add unticked deposits to the cash receipts journal, and we're going to add unticked credits to the cash payments journal. So we're taking the ones from the bank statement and we're adding them to our two journals. Okay, so if we have a look here over at our cash receipts journal, we've added in those fees for $400 and we've added in the interest of $100. So there were two items which appeared on our bank statement which weren't on our cash receipts journal. On our cash payments journal, we had the computer. Oh, sorry, the fees and interest. Oh, so the only other one that we need to add in was the bank charges. There was the bank charges down the bottom for $15. We'll go into the computer in just a second. Now, so that's step 3 and step 4, and we're going to add those to our bank reconciliation statement. So our bank balance was $1,585, and we add on our deposits, which takes us to $1,985. Now, we need to minus off from our bank amount, from our bank statement, the unpresented checks. And you see this is for the computer. The computer for $300 isn't on the bank statement. So we need to minus that off what is the figure that's actually in the bank account. So I'll just talk through that again. So the bank statement shows we've got $1,585. It's missing a deposit of $400, and it's also missing the unpresented check of $300. Now I think I may have missed something there. The interest, which I've got over on the cash receipts journal for $100, remember that came from the bank statement. There was $100 on the bank statement that wasn't in the cash receipts journal. Okay, so we'll just go back quickly. So if we look over to the bank statement, there's the interest of $100 there, and there's the bank charges of $15. So they're the two items, the bank charges and the interest, which have been added to the cash receipts and cash payments journal. There's the interest for $100 is our cash receipt, and the $15 is our cash payment. Okay. Over on our bank reconciliation statement, we've added on the deposit, which needs to be made for the fees, and we've minused off any cash payment which isn't listed. Now what that does is that gives us the total balance as it actually should be. The total should be $1,685, not the $1,585 we had, and not the $1,600 we calculated. The total should be $1,685. Now if you look down here in the bottom left at the bank balance, this is like the bank balance at the bottom left here. That's the internal bank balance calculated as part of our accounting process. So now the bank balance at the start of the month was $1,200. The receipts is now $1,300 because we've added in the interest. The payments is now $615 because we've added in the bank charges to the cash payments journal. So now you can see the bank reconciliation statement and our bank balance actually match up, and they're now balanced. Okay, now so just before we go into bank overdrafts, it's really important that you understand and can follow those 5 steps. So the first step was tick off on both the documents, on all 3 documents, which is cash receipts journal, cash payments journal, and the bank statement. You tick off all the transactions to make sure they match. The next thing is you look at the ones that haven't been ticked. Any of the ones from the cash receipts and cash payments journal that haven't been ticked need to go onto the bank reconciliation statement. Okay, so ones from the 2 journals go onto the reconciliation statement. Any from the bank statement that haven't been ticked, they need to go into the receipts journal or the cash payments journal. Okay, so it's like you need to swap them over. From the bank statement, unticked ones go to cash receipts and cash payments journal. The cash receipts and cash payments journal go onto the bank reconciliation statement. So remember that that bank reconciliation statement, what that shows you is that's the document for your business, which shows you what's actually happened between your bank statement and your 2 cash journals. Now, there was a bit of a question on the exam about this one, about the overdraft. So an overdraft is a bank account with a negative balance. So that's basically if you've spent too much money out of what your bank, out of what you've actually got in your bank. Now, what's going to happen is you're sometimes going to need to have a bank account that's in overdraft, and you're going to need to reconcile the account that's in overdraft. So you receive your statement, it says you've got $400, you owe $400 to the bank, and then you need to go through a bank reconciliation process. Now, there's really only one thing you need to do differently if your account's in overdraft. On your bank balance, you just need to put OD over next to the bank balance. So OD stands for overdraft. So let's imagine for this bank, you receive your bank statement and it says you're in over by $400. You'd put down bank balance $400 overdraft. Now let's imagine that you had 2 checks that hadn't been presented yet, so people hadn't taken them, worth $300. That means you actually owe the bank $700. Okay, because you've paid somebody else $300, but it's not in your bank yet. Sorry, it's not in their bank yet, so it has been taken out of yours. Then you need to minus off any deposits that you haven't yet credited. So let's imagine you got $100 from somebody who deposited into the account, but they forgot to tell you about it. That would mean your balance on your bank reconciliation statement would be $600 overdraft. Okay, so what that's actually showing is saying you received a bank statement that says you owe the bank $400, but based on your records, you know that really soon you're actually going to owe the bank $600 because there's $100 that hasn't gone in from your money, but there's $300 that hasn't come out either, and both of those things haven't been listed. Now this is the last bit. This is the bit where it gets kind of tough. Now, bank reconciliation doesn't happen just once each month and finish, and that's all you need to do. Because what will happen is it'll keep happening every single month. So at the end of the month, when you start doing the bank reconciliation process, you need to check the items from your previous reconciliation. So thinking back, maybe you had a check during one month that was dishonoured, so you hadn't been able to cash it. That check's still going to be there a month later, and you still need to work out what's happened. Maybe you had a transaction from 2 months ago where you paid somebody using a check, and maybe they still haven't cashed the check 3 months later. So you need to keep checking whether that check's been cashed. So to do that, during your first 2 steps, so the first 2 steps of the reconciliation process, so you take your cash payments journal and your cash receipts journal and tick them off. You also need to take last month's reconciliation. So you need to get the list of the things that are still outstanding and tick those off as well. So this diagram I've got here, what it's showing is you need to get your cash receipts journal, your cash payments journal, last month's reconciliation, and you need to get the bank, on the other side of the diagram, you need to get the bank statement, and you need to compare these three things on the left to the one thing on the right and put the difference into the current reconciliation document. Okay, so if I go, I'm just going to go back and show you, this is the example of the one of the bank account and overdraft. Have a look at these two transactions of these two unpresented checks. So check number 1238 for $100 wasn't presented, and check 1239 hasn't been presented for $200. So during the next month, those checks might still not be presented by the people you've paid with them. Okay, so you've given somebody $100, you've given another person $200, but maybe they still haven't banked those checks. So when you come to do your reconciliation, you need to go back to your this reconciliation document and you tick these off as well. So you go, yep, that's been paid now, that's been paid now. If it hasn't been paid, so if they haven't presented them, you need to add those two checks to your next month's reconciliation document. So they're still gonna be there. So they'll be there until the people actually pay them, actually cash the checks. Now that's absolutely everything for Chapter 7 and the bank reconciliation process. The overall process is quite complex, but you just need to follow the steps and practice following the steps, and it becomes easier after a bit of practice.